This week we are coming out with two interesting webinars, and the first webinar is what should you do when the market goes nowhere? The investment strategies that work. And the second webinar is women's only webinar, that is Kodishwari webinar, investing between market chaos, where we discuss on how to navigate through market hurdles for your investment journey. To join the webinar, click the link in the description.
Hi everyone. If you're already a client of Milestones2Wealth, Harshal will definitely be a familiar face. You might have seen him in our exclusive client-only webinars every weekend. And for those who don't know him, he's our in-house investment strategist. And in this conversation, we're going to be speaking about the questions that matter most to investors, about your portfolio, the market outlook, managing risk, and understanding investment behavior. So Harshal, let's start with the basics, which is surprisingly is often ignored by the industry, right? So how important is risk profiling when it comes to building investment portfolios?
See, risk profiling is extremely important just for two simple reasons. Your ability to take risk and your willingness to take risk. You need to have a proper understanding because both are completely different. You might have deep pockets, but you actually are not a risk taker. Second, you might be a really big risk taker, but you don't have deep pockets. So naturally, you need to have that level of understanding for an investor, whether their ability and their willingness goes hand in hand. So we make them take a test, right? So we make them take a risk profile test, and all the investments are then invested based on their particular risk profile: aggressive, moderate, conservative. So everything is as per your risk profile.
Okay, now speaking of aggressive, moderate, and conservative investors, especially for investors who have started investing since COVID, that is 2020, have seen predominantly one-way market rally, right? Except for periods of drawdowns, they've seen the market go up. And there is this misconception that to be earning higher returns, you need to be taking higher risk. So people who are in the conservative or moderate zone might think that they might never see higher returns in their portfolio. So how true is that?
It's very true. See, the thing for high returns and high risk is that it's not always going to be that case. Last 3-4 years is a very good exception, where you've funneled global liquidity into stock markets. You've had every single thing that you put money in make a lot of money. This is not that case. It's not that high risk is equal to high returns. For example, 2018, small cap peaked, and after that, if nobody put SIP or put incremental money, at the peak of the market or the next peak of the market in 21 was your sub 6%. 6.5% sort of CAGR. Now, if you have a 10-year horizon, 50% of the time that you're staying invested, you're not growing. So it's not always that high risk is equal to high returns. But when you catch it at that valuation band is where it actually goes and matters, and it adds on to your CAGR at the end of the day. So we do this thing, right, where you yourself have called many investors that this is a bad time, let's go and put a lot of money, it's as per your risk profile, this suits you, let's go and put some money so that you can reach your milestones a lot more faster. And we've done this for so many investors where we push them to reach a milestone faster. So it's at that time when you catch in those products at the right time, when they start working for you, even if they're a extremely risky product. So last 3 years, don't go by what has happened. We always look forward into investing, and given how things are, you really need to moderate your expectations. Don't be spoiled because the market gave you something. Don't let it boost your ego because be honest with yourself. It's the market that gave you the return. You didn't deliver that particular return. That's how we also see it. Right.
I think that partly answers my next question, which is going to be about small caps, right? I think since 2018, I thought we have not directly invested into small cap mutual funds, although we have taken exposures through sectors or themes. So is there any particular reason that we are not, directly investing through small cap funds?
See, after the SEBI reclassification of what a small cap is, you have only that many number of stocks to go out and invest in. Everybody is going to be chasing the same thing, right? Fund managers, investors, everybody is going to be chasing that particular name. So it's going to be there in the top 5 or the top 10, it's all going to be common. Like your large caps, when you see large caps, you'll see HDFC across most large caps. You'll see it across large and mid caps, you'll see it across flexi caps, right? But that's a large cap business. So you have a good amount of float that's there. Here you do not have, right? So when we were ideating on what should be the idea that we want to invest in, and when we found within small caps, this part of small caps is extremely cheap, say capital goods, Then we said that, okay, consensus is not overweight on capital goods, and being a contrarian, is there, we were seeing for signs that, okay, is there going to be change that can take place? And 2021 was a period where infrastructure had to be spent upon by the world. So when we were able to find that particular idea, that became a direct exposure towards small cap, and at the same time it became a direct exposure towards infrastructure spending. So it got the net result of both. So it did phenomenally well for us. But seeing that universe and that constraint from 251 all the way till 500, that everybody is going to be putting money in the same business, in the same basket, we had to think out of the box. And the only way where you can think out of the box is to have a contrarian approach.
Yeah, that's an interesting strategy to have. So now I want to understand how the current investment portfolios are positioned, right? Where are we investing now? And what is your outlook generally on the markets?
Like all webinars that we do, I'm going to tell you the same thing that we are giving outside publicly. See, don't expect high returns coming in for the next couple of years. At least this year, have very, very moderate expectations, probably next year as well. But this is a period where you get solid opportunities to go out and invest in, because here you get to see who's going to come out the best, right? It's not that there's no need to run behind a past winner thinking that this will always be a winner. There will be a next winner that comes up, right? That is one. Second, have a multi-asset approach. It's not that you have to go and put money in multi-asset funds, but have a multi-asset approach, right? Which means that because equity is at that place where it's not extremely valued, so you look at it more from a fair, cheaper, fair, expensive, very expensive, right? So it is between fair and below fairish. It's not very cheap, it's not cheaper at all, but you can say it's reasonably at that range where, okay, you can participate in certain segments of the equity market. Now, where I would say that the cheaper parts of the market today are consumption first, right? Banks and financial services still are on the fair valuation side, but these two baskets reasonably have good earnings growth lined up for them. And from a broader theme perspective, it's more India consumption story that is pretty visible. And financialization of Indian households, that's again pretty much visible, right? Because of what's happened over the last 5 years. Right? So see, these two broad themes are something that investors should definitely look for, because we are looking out for them. Debt again is an unsung hero, and it's been shunned away as an asset category since COVID, and nobody really cares about it. But you get very, very small, limited arbitrage type opportunities that you can take advantage of. So in this period where things are not looking as great as what they did last couple of years, having a multi-asset approach works. And within a multi-asset approach, look for segments that are reasonably valued where you can start building positions. The most important thing for you coming up next is how much of something I should buy. That you should have a staggered approach, have it more calibrated, and build on that conviction going. For us, it takes at least 2.5 years just to build a very, very high conviction in a particular theme, right? We start off slow and make sure that we have a lot of skin in the game for a particular portfolio, right? Any risk profile whatsoever in that particular idea, in that particular theme, make sure that you have a lot of skin in the game. So it's very, very similar to, the strategy that we are following is what I would tell everybody else to also hunt for.
Yeah, basically in short, one is moderated return expectation, second is staggered deployment, and third is going to be multi-asset approach. Multi-asset being the most important.
Perfect. Yeah, just have active participation that you can do during phases of reasonable valuation, because India is that country that is offering the world a high 6.5-7% sort of growth rate. So we are there, right? We are going to be part of the global supply chain in whatever way, even if it is not as comparable to that of China, because they are huge and they are leaders, right? But we are going to be included in that supply chain, so we need to be there.
Fair. So that brings me to the next question. You mentioned about consumption, you mentioned about banking and financial services, and also about debt. So there are too many funds on the market that is going to be investing in these areas, right, or these asset classes. So how does Milestones2Wealth, choose funds? You don't have to get into the specifics or technicalities of it. Of course, what do you look in, when you're choosing the funds for our clients, and also what are some of the red flags that you tend to, look for to avoid investing in those funds?
I'll just tell it to you in one line, probably. Experience matters a lot, right? If you've seen multiple cycles, then you know when to catch bought at a particular point in the cycle, right? And this cycle works for any asset class, right? It works for precious metals, it works for debt, it works for equity as well. So when we want to partner with someone, then we look straight for that particular level of experience, right? Now, going by track record, we try to understand what went right, one from a broad perspective, what went right with the fund manager, with the AMC, and likewise what went wrong, and why it went wrong in that particular manner. By that, we clearly know that, okay, this is a segment that we want to concentrate on. This is a segment that we do not want to concentrate on. Right? So that fits within our investment philosophy. And once it fits within our investment philosophy, then more behavioral oriented conversations start coming in with who we want to partner with. And then it fits within risk profiles, and only then investors get to participate in them very heavily.
That's interesting. So you spoke about how you will be, selecting the funds. So you gave us a broad idea as to how it's done. Now let's go beyond that, right? So managing portfolios is not only about choosing the right funds, it's also about investing at the right time, position sizing and all of it. So can you tell us more about the system that you and your team have built for, the clients, to ensure that they're communicated about the opportunities at the right time, so that we're transparent with them and telling them, why we do what we do. So can you tell us about the system that you've built?
See, this didn't come to us in a day. We've evolved since inception, and it's just been a learning curve as to just what sort of communication people respond to, right? So it's more tailor-made now than it was before. That's one. And second, see, when we started Milestones2Wealth, and when, the ethos of iThought is that it's by an investor for the investor. Right. So at the crux of it, how does an investor make return? One, they catch it at the right time, and second, position sizing. So having more of it when the risks are lower, right, matters a lot. So when we covered the entire research part out, then we were looking majorly at the behavioral aspect of things. And for that to happen, we built systems in place where reviews used to take place quarterly. Now it's monthly, where we look at every individual portfolio and see, this is the milestone that they would like to achieve, and, where are they currently, and what this particular investor can do from their side to make the milestone get achieved a lot more faster. That's why we have, at the first stage itself, we take the risk profile, we take a financial health checkup to straight away give you that level of direction and guidance to say that, you are here, and if you want to achieve this, these are steps that you have to do by yourself. So that came to us when we were doing the reviews, straight away, and then having the ear to the ground, where we would have interactions. I have interactions almost every day with investors, right? So does the team, right? Where we understand straight away that, this is what we would like to do, and for you, and this is what you would like to achieve. So get all of it in alignment, right? It's not just about giving you a product that, this is the best product in the world, go and invest. No, it has nothing to do with the product, comes a lot more later, but a clear understanding of the direction that we have to take in is actually what sets our process apart. Then come in majorly, once you're on board with that, and once you have a clear understanding of how your financial balance sheet looks like, then it becomes easy for us, where we are able to get in touch with you through all channels that we have, through the app, through WhatsApp. You are communicating to them, whenever their opportunity that comes. So a lot of it becomes a lot more dynamic, and flexibility becomes very high. So already we have built transparency on top of it, so it works as a proper triangle. So at that point, people started appreciating, investors started appreciating that, you're doing this and it's helping me out a lot. So we said, if it's helping them out a lot and we are able to build this at scale, let's amplify it. So that's how we got into where we are today, where communication comes to you instantly when we see that there's an opportunity that each individual investor can take advantage of. So that is the systems that we are following. In terms of controls, every transaction, we make sure that every transaction is being put on time, right? Because it's very important that you get that day's NAV. So proper controls have been set in place that if you say a yes, that next second we should be ready to put it out for you, and within that 1 minute a transaction should actually happen for you.
Yeah.
So such infrastructure and such architecture is actually placed for us, where it's straight coming from the brain itself. It's not coming from one individual. It's coming straight from the brain, right? And there's a lot of love and appreciation for that. And definitely at scale, this would work.
Yeah.
It has worked up until this scale, and as we scale higher, I do believe that this would work out.
So yeah, we've come to the end of the conversation, and if you found it helpful, do share it with your friends. And if you haven't joined the Milestones to Wealth program yet, it's simple. You just have to fill out the form in the description below and we'll get in touch with you.